Hey, what's going on YouTube? In this video, we're going to go over Nvidia Corporation, ticker symbol NVDA. They reported their Q3 24 earnings November 21st, beat on top and bottom lines, and we can see they beat on their revenue by $2 billion. And all 37 analysts covering this company have revised their next quarter expectations higher. So year to date on Nvidia, it is up 234%. Over the course of 1 year is up 194%. And our forward-looking PE is about 39.5 right now. So in their earnings call summary, they reported that record revenue of $18 billion, which is up 34% from Q2, 206% from last year. Data center revenue of $14.5 billion, up 41% last quarter and up 280% last year. So in their outlook for next quarter, they're expecting $20 billion, which is about a 10% increase in revenue growth. And then gross margins are expected to be about between 74.5 to 75.5 for gross margins, which is slightly higher than where they were last quarter at 74%. So the reason why this company is down after reporting earnings is obviously not because of their beat on top and bottom line, but is because, and I'm kind of surprised this already hasn't been priced in. It's a little bit of a shock to me, but you know, that just gives us an opportunity to potentially purchase this stock now that it is starting to see some decline in value. So towards the end of the quarter, the U.S. government announced a new set of export control regulations for China and other markets. So with these regulations, it requires licenses for the export of a number of their products, including the Hopper and Ampere 100 and 800 series and several others. So their sales to China that are now subject to license requirements have consistently contributed about 20 to 25% of their data center revenue over the past few quarters. So if you take their $14.5 billion, you take off 25% of that, that's about $3.6 billion. If it's 25% and it just all gets eliminated, max amount is about $3.6 billion. But even with that reduction in their revenue on their data center, they're obviously still forecasting $20 billion next quarter on revenue, which is still a 10% increase quarter over quarter. So they're not expecting this to be too big of a deal. And I'm wondering if investors don't quite believe that, or maybe they're thinking like, I don't know how you're going to recover $3.6 billion. It's probably going to be a little less than that, but recover $3.6 billion and then grow an additional $2 billion on top of it. If they were to grow $5 billion from where they are right now, so it'd be, if you take 14.5 minus 3.6, that would give you about $11 billion of revenue of no growth. So if they were to recoup that 3.6, and again, this would probably be less than that. So if they were to recoup that 3.6 and grow an additional $2 billion on top of that, you're looking at about a 45% growth rate on that. Well, obviously 3.6 is probably, you know, worst case scenario, so it might be a little bit less. So you might be seeing 35 to 40% growth rates still on revenues, which is incredible. Obviously, we can see last quarter, they grew 34%. So it's definitely doable. They can still continue to grow at a 30% growth rate, and that's what they're forecasting. They're thinking about 35 to 40% growth rate for next quarter. That'll recoup all of this hit that they'll see on their data center revenue and then some. So again, a little surprised that the market is seeing this as a negative right now, because the company itself is forecasting growth, and the company also historically, when they forecast their revenue, they beat on all of their forecasted revenues. So we can see that they always sandbag on what they say they're going to actually produce. So there's a good chance that next quarter, instead of seeing $20 billion in revenue, we might somehow see $22 billion in revenue, which would be insane. Over to the financials to see how this company is performing. We come over here to our charts. We got our revenue, gross profit, and net income, all three just exploding higher. We can see our net income just shoot just a straight arrow up. Gross margins, this is where it gets incredible, is that their margins just continue to get better and better and better. And a lot of those margins are carrying over to net margins, which is making them a lot more money. But they're up last quarter up to 51%, trailing 12 months, 42%. So their margins are continuing to get better on net. And also gross margins, we can see, are up about 4% on gross margins from last quarter compared to trailing 12 months. And we can just see revenue, gross profit. We're just seeing incredible growth on the company. Return on invested capital, 28%. Earnings yield sitting at 1.5%. PE ratio today is at 63. Cash to short-term debt, the company has way more cash than short-term debt. and almost enough cash to cover all of their current debts. And actually, if you look at this, their total current debt is sitting at $20.8 billion. And if you look at their free cash flow, if they can grow their free cash flow a little bit more, their free cash flow alone could almost cover their entire debt. But net income to free cash flow, we can see here we got free cash flow 14.8 and net income in total of $19 billion. Capital expenditures are just very good, just kind of hanging out at about $1 billion in the capex, and kind of retracting a little bit as well, which is fantastic. Share count dilution, we're sitting at 24.94 billion shares outstanding, and we can see they're buying back a little bit of shares. There's not a massive buyback. We can see they are currently buying back shares at the current time, but they are also issuing out stock-based compensation as well. Dividend, company does offer a little bit of a dividend, but not much to get too excited about. Looks like dividend payout is about 12 cents per share. Over to the comps, I pulled up two other companies to compare to. That is AMD and Intel. And we come down here to our comparison charts. We got our market cap compared to revenue. And I mean, you can kind of see where that's at. We got our revenue, gross profit, net income. Intel does produce more revenue than what Nvidia does. When we come over here to 5-year growth rate, obviously Nvidia is going to see a much better growth. And margins also. I mean, we just look at everything here. We just kind of scan over the page. We can just see how fantastic the margins are at Nvidia, and the competition. Anybody that's trying to compete with Nvidia right now is they're just so far behind at the moment, especially when it comes to margins. Free cash flow, $14.8 billion. Return on invested capital, PE. We can just, I mean, it's just like a no-brainer that Nvidia is obviously has a substantial lead over the competition right now. Over to our calculator spreadsheet, peanut valuation. So currently we're going to use today's numbers, today's EPS, and today's PE ratio, and then we'll plug in forward-looking numbers to figure out what the thing is valued at forward-looking. So Peanuts valuation gives them $236.06 per share. Our multiples comparison, so Intel is currently negative and AMD is positive, but they have a PE ratio of 964, so we will not be using that one either. Manual PE, we have our market cap minus cash, add in debt, divided by cash from operations. It'll take this company about 74 years to earn its current market cap, which kind of tells you a little richly valued. Price to book, 5-year average, 22. Today, 35. Our PEG ratio today, 109, and forward-looking PEG, pretty cheap. Graham's valuation gives them $420.74 per share, and our dividend discount model gives them $216 per share as well. Discounted cash flow. So average growth rate 60%. Analysts are forecasting 73%. So we can give them 60% to match what they've historically done. If we do that, that gives them a discounted cash flow price per share of $637. We can potentially leave it at that, just because historically showing that, and analysts are forecasting much higher growth rate and free cash flow. Rule 72, we have 3 sources of EPS growth rate. Yahoo Finance was actually a positive, was not a 0, but I want to average down a little bit on EPS growth to 32%. So with that average, I doubled their current EPS only 3 times. And with that 3-time double on their future EPS, it gives them 61, and that gives them a fair value today of $967.70. Could be a little richly valued because this company is so big and growing so quickly at such a high EPS already, that, you know, this calculator is a little bit challenging to utilize with this specific situation. But summary, currently Nvidia trading at $477.76 per share. Fair market value that we got off of all of our calculators today is $495.46. 30% margin of safety is $346.82. And analysts have a price target of $609.89. But let's circle back and let's plug in our forward-looking numbers on this company, which we've got 12 for EPS and 39.5 for PE. So when we plug in those numbers, that gives us a peer fair value of $377.32. And we come over here to Graham's valuation. That gives them $672.54. Our discounted cash flow will not change. Our Rule 72 would typically change, but because we're already sitting at about $900 some per share, we're just going to leave it where it is. So with that, forward looking, we get $574. 30% margin of safety is $402. Analysts have a price target of $609.89. So not too far from where analysts are. And I believe all these numbers are pretty well balance. You know, you take your dividend discount model, which is pretty low, but you take your rule 72, which is pretty high. Those kind of offset each other, and the rest all kind of balance out and give you an average of $574 per share, which I think is a pretty good valuation on this company right now. Over to the stock chart. We have about 4 different trend lines here we've drawn in since about May, end of May, early June. We've kind of been trading sideways, really just in this channel. And we've been hitting the top of the channel, pull back to the bottom, hit the top of the channel, pull back to the bottom. So I'm guessing on what is to potentially happen with this company right now. Earnings came out. Analysts were a little spooked by the whole China restriction thing. I think we might pull back to about this trend line here. Depending on how quickly we get there, we're probably looking at about $450 per share. Personally, I think that would be a great buying opportunity. A 30% margin of safety on this company would be back at the bottom of the channel, about $400 per share. I think I would start picking some shares up at about 450, save a little bit of money in case it does pull back a little bit further, pick up some more at 400, and then this thing might reverse, come back up, and maybe finally break through this channel and find its way up to $550 to $600 per share in the not too distant future, which is about right now $100+ away, depending on how you look at it. Right now, it's about $100 away from our fair market value forward looking. So, but that is it for Nvidia. If you found value in this video, drop a like, subscribe, comment. I'm back later with another stock analysis video.